lunch. Now we're going to start with the second phase of the day. For that, we have some industry experts with us today who are going to discuss some currently talked about topics in the PNC industry. Before we start the session, I would like to read out some housekeeping rules for the benefit of all. Request you all to have your gadgets on the silent mode. This session is going to have 3 topics with 25 minutes assigned to each of them. We will be taking all the questions at the end of the session. You can submit your questions on slido.com. Please use the QR code as seen on the screen or use the hashtag 4042584 to submit your questions throughout the session. The topics which we are going to cover today are, first topic would be crop insurance revenue protection. Crop insurance is not something new, but in recent times it has gained great importance. It would be really interesting to hear more on this. The second topic would be optimized reinsurance portfolio steering. I'm sure with the increasing risk and ever-growing insurance market, having an optimized reinsurance portfolio could be really useful. The third topic is quite similar to the second one, where we will be talking upon reinsurance optimization, especially for the non-life insurance. I recently heard a concept on reinsurance bouquet, not sure if that could also be called as one way to optimize reinsurance for non-life insurance products. So to begin with, I would like to invite the session chair, Ms.Girija Subramanian, Chairman-cum-Managing Director, Agriculture Insurance Company of India Limited, on the stage. Please, ma'am. I would also like to invite and welcome our speakers for the session. Dr. Satya Mudigonda, Adjunct Professor in Actuarial Science, Senior Tech Actuarial Consultant, Sri Sathya Sai Institute of Higher Learning, SSSIHL. Dr. Rohan Yashraj Gupta, PhD, Visiting Faculty at Sri Satya Sai Institute of Higher Learning and Consultant at RSA Actuarial Services, India. Mr. Fani Krishna Kandala, EVP Swiss Re, Australia. Ms. Ruchika Sangwan, Associate Director, Willis Tower Watson. And Ms. Tanushri Gupta, Associate Director, Willis Tower Watson, to share their thoughts. Ma'am, I would request you to come and say a few words.
So good afternoon, everyone. It's very trying to have a session immediately after lunch, but we'll try to make, I'm sure with these esteemed speakers, they'll make it very interesting for us. Yeah, so crop insurance is a very interesting and dynamic area, which has been assuming increasing importance year after year. This year is especially very important year because we are having a lot of transformation happening in the crop space. As you may all know, that the crop insurance is dominated by the Pradhan Mantri Fasal Bima Yojana, which also occupies around 99% of agriculture insurance company portfolio. And I think it's the same with the rest of the other insurance players in the market. So in this space, there is going to be a lot of change with the government stepping in and trying to introduce a lot of new methods in crop insurance. Earlier, it was being the states that were adopting the PMFBY. Most of them were doing it on a whole entire risk basis. But few states tried, implementing the cup and the cap model in the last 2 years. Madhya Pradesh, and some of them tried to include entirely, doing the claims assessment on technology basis. This sector is one that, although it is related to the farmer and it's a rural line of business, it is the business that leverages technology maximum, and technology can be used, right from the inception to the claim process. Technology can be used in a very big way to make this a very big success in any country, in India in particular. So right now, the transformational changes that are happening is a lot of guideline changes are happening in the PMFBY, with the government proposing to introduce a lot of technology into the claims assessment part of crop insurance. And also, the scheme is going to be compulsorily, 30% on technology basis, 70% on CCE basis, which is a crop cutting experiment basis. And along with that, there is a slew of other changes that are being proposed, that state governments would be allowed to, go for the 80-110, which is a cup and cap model, where 80% of the, if the claim ratio goes below 80%, then 80 minus the claim ratio would be refundable back to the state government. Anything above 110 would be picked up by the state government. So this is a cup and cap model, which is going to be, allowed as part of the PMFBY scheme, which was not the case earlier. So this is completely going to change the way insurers and reinsurers and also the state governments look at crop insurance. And this is going to change the dynamics, the insurance premium, and consequently the reinsurance premium coming out of this line of business. And also because technology is being introduced in a big way, the outcome of this entire exercise is also going to be hugely different from the previous years. So we are all actually waiting with bated breath, because as we speak, one of the governments is rolling out the tender, the first one in Karnataka, and then will be followed by the rest in the country. And then as we get all the tenders and the submissions and the results are out as to what the state governments want by way of this tender exercise, we would then know what would be the collective risk exposure in the country. So that is something which everybody is, there's a lot of uncertainty around crop insurance currently in the market, which in a month or two will get demystified. And then obviously, then the question of reinsuring the same remains, which would be another exercise altogether. So very interesting topic, and we have the best people in the business to throw light on this. Mr. Sai Srinivas, Mr. Rahul. Rohan, I would really look forward to hearing more on crop from you. As regards, Mr. Funny and Mr. Satya Sai again would be talking on property insurance and casualty insurance. And reinsurance of casualty business, and how to steer the portfolio around the casualty business. They would be talking more. It's also a very interesting topic, because with a lot of regulatory changes coming our way, and the government and the regulator pushing for a 100% penetration by the year 2047. I think most of you are aware that there are targets that the regulator has set for the next 5 years from each company, that really requires us to not keep carving out of the same pie, but go and seek a new business, unpenetrated market. And in that context, obviously, the retail business becomes key, and how you reinsure the business becomes even more key, because it's going to be capital intensive also. And last but not the least, we are having the two ladies here who will be talking on property and casualty property reinsurances, basically, and how we can optimize reinsurance for the property class. So I'm sure we are looking forward to very interesting presentations from all of them, and look forward to hear from you.
Good afternoon, everyone. Crop insurance, we did a real project. So it's an application of what we have seen in various markets to India. So this project actually is an actuarial data science project, because they dealt with big data. It's about 30 lakh rows of various crops we picked up. So we worked with various agencies, various companies, where actually government agencies also, Agmark, where actually we picked up data. And we worked with NCDEX, where actually the asset side of the calculations actually we have done. Then, as usual, the data science side, we applied various techniques and tools so that actually we get to the how it looks if we apply the crop. We can say actually crop revenue protection, like it can be insurance or it can be some other way, doesn't matter. Then other part of it is actually we have Fasal Bima Yojana, so that actually we want to clear off that. Fasal Bima Yojana covers different types of risks. It doesn't cover price fall. So that being the case, actually the price multiplied by the quantity, that is the revenue the farmer is looking for. So that part actually we want to ensure like that is protected. So the government's intervention is there as part of this called minimum support price that works to one level, and every year our country spends about 25,000 crores on that. That's a yearly activity. But it's not, it's a interventional, it is not a permanent setup. And this problem is not just for us, it is actually worldwide we have the same thing. So to take it forward, I request Dr. Rohan to get into technical sides, and then we'll be sharing based on wherever it is required.
Yeah, greetings to one and all present here. So thank you for the introduction, Satya. So we'll be starting with some background. So as Satya already mentioned, so we already have Fasal Bima Yojana, which is a plan which is there to protect the farmers against the yield risk, right? If there is a lesser quantity, lesser produce, so that's also a risk to the farmer. So there is a scheme already available, but what we are trying to address at this next 22 minutes that we have is what are the other aspects, which is the price risk and the quantity risk, right? And what are the various strategies which are being implemented in other wider economies. To be specific, US market will be looking into, and how those considerations can be derived and looked at from the Indian perspective, and then discuss some of those strategies. And there would be various calculations which we would be seeing throughout the presentation. But however, the entire agenda would be more an understanding why this is a cause to the Indian farmers, right? And why this should be an important topic of discussion. So coming up to the very first slide on the background. So as Satya already mentioned, so there is a minimum support price with which the government of India guarantees. So this essentially means that if the price of a particular crop falls below a specific falls below a specific price, which is the minimum support price, then the government guarantees that that particular price is there with the farmers. So this risk is huge, and there is no limit to what this risk can be, right? And there is also high degree of variability which is there, because it changes along season to season. It changes across various geographies, the price that would be coming up, and then there is also high degree of fluctuation which happens. So there is a high amount of risk which is involved whenever a government guarantees a minimum support. And this minimum support price varies from crop to crop, and it is decided during the sowing season by the government. And coming to what are the various hedging strategies that we can look at. So there are various derivative options which we have, as we would see, which the United States are adopting, and then we will see how some of those can be implemented. With that, we come to the very first section, which is the product design strategy. So in the US market, so there is this product, the crop insurance revenue protection product, so which is designed by the United States Department of Agriculture's Risk Management Agency, and they are involved in designing, rating, and underwriting this product, and it is sold through private insurance companies, and the agreements are already as it is decided by the risk management agencies, and it is offered to all the farmers in the United States. Correct? So this is also important for us to know that there is a standard agreement which is set, so which helps the insurance companies who is selling who are selling this product to ensure that there is a limited exposure to the underwriting risk, because all of these terms and conditions are already determined by the risk management agencies. Now, talking about the reinsurance industries that we have. So in the reinsurance segment, so the government in the US, it ensures that each and every insurance company who is supporting this particular product, they are covered by a reinsurance agreement. This helps them also ensure that there is a limited amount of risk which they are exposed to as an insurance company. And why is this important? It's important because crop risk can be very high, and amount of capital which they are investing in order to cover such risk, and the amount of return which they are getting. It might be more better if the insurance company were to insure some other products, right? So there has to be some incentive. So government, they provide such reinsurance arrangements to ensure that they are able to engage as many insurance companies as they can. And like there are standard agreements when it comes to the insurance, there are also standard reinsurance agreements which are there, so that things are all defined and the amount of exposure to risk can be contained. And apart from that, they also encourage private insurance companies, if they are able to get the reinsurance arrangements, they also encourage that happening. And also mind you that generally the kinds of insurance and reinsurance companies who are involved in such schemes, the crop revenue schemes, they are larger, they are the bigger insurance and reinsurance companies, because the amount of risk exposure, as I mentioned, is quite high, and they should have the risk appetite to cover such risk. And so there are lots of systematic and non-systematic risk as well. So the non-systematic risk, which is diversifiable in nature, so insurance companies are not much concerned about that. So I'd be talking more of it when we are talking about the Indian perspective. But what is of more concern is the systematic nature, the non-diversifiable nature of the risk. So that is where the futures and options, the derivative markets comes into picture, and that is how they handle such risks. And talking about options and futures, the benefit of options which we see over futures is much higher, because as we know, right, the options, in an option we have the right but not an obligation. But in future we have an obligation. So whenever there is an obligation, the amount of risk which is there is generally higher, right? So that's why when we say in option, when the obligation is not there, the risk is generally lower than what we would see in the futures. So talking about the Indian market in specific, so there are these three things which I wanted to highlight, touch upon. So first thing is, what is the liability, right? What is the claims cost that we are talking about? So this is where we have some equation here, so which is essentially MSP here indicates the minimum support price, which we have been discussing. And then there is this market price at the point of harvest for the IAT district. We are talking district by district. So whatever is the difference between that, and if the difference is non-negative, that's the loss which we are talking about. And as you can see, so there is no limit to what this loss can be, right? And it is also dependent on the quantity which is produced. If there is a very high quantity which is produced, then, and also if the prices is much below the MSP, so we have the liability scaled to that extent. So we should also see here that the kind of risk which we are talking about here, right, is the systematic and non-systematic risk. So the systematic risk I discussed in the previous slide, that there are derivative strategies which we can look at. But what about the non-systematic risk, right? So in the non-systematic risk, so there is a the negative correlation of geographies is what they can maximize upon the insurance companies. So what essentially it means is, so when at the particular, say during in the northern side of India, if the harvest is not so well and the prices are falling because of some geographical reasons, we might find a geographical place which is negatively correlated in terms of all of these factors, the weather factors, the soil, and etc., which determines this produce. And we can maximize on that aspect also to hedge certain kind of, so this kind of non-systematic risks. Then there is this risk transfer, which is the derivative capital market solutions, which we will be looking into. So coming to the second section, which is the product pricing strategy. So we'll be discussing on these 4 different sections, which is first is the implementation of actuarial data science. Because the data which we are using here is of it's a big data problem. So there is a actual data science element, and we'll be looking into what are the various aspects which we need to take into consideration. Then the second aspect is calculating the expected value of claims cost. So whenever we are trying to come up with the premium, right? So there are essentially 2 things which we are looking at. One is the claims cost, which is the liability, which I just discussed. And the other aspect is when we are trying to bring in the derivatives here, there is an uncertainty in the expected income, the asset part of it. That is another thing which we need to take into consideration. And once we have calculated what the expected value of the claims cost is and the cost of the uncertainties in the expected income, that's where we'll be able to determine what the premium that needs to be charged. So with that, we'll come to this slide. So which is whenever we look into a problem from the data perspective, right? And we talk about models like machine learning and deep learning. So this is a schematic representation which highlights what are the various phases that we need to go through. And each of these phases we need to go through when we are trying to deal with data from a data science perspective, right? So here the agenda that we have is the asset liability projection. So the very first aspect whenever we are looking at the data is the data pre-processing aspect, which deals with things like data collecting, data cleaning, and preliminary data analysis. So this would include things like web scraping the data from the internet. So the sources of data here was AgMark. And the NCDEX. NCDEX is the National Commodities and Derivative Exchange, and AgMark, it produces data of price and quantity of each of the products for each of the day across all the districts of India. So that's how granular the data is available. So obviously, manually doing such things would not be a viable solution here. So we had to do a web scraping kind of algorithm to extract those data, and then not just extracting. So while extracting the data, we should also ensure that we are cleaning the data appropriately to be able to use in our models that we are. So we use machine learning and deep learning models. So I'll be discussing about that. So once we have the data pre-processing aspect, then we also look into the descriptive statistics, like year on year, how has the figures changed, right? When we talk about the price, when we talk about the quantity. So we need to do a descriptive statistics to understand more about the data. Then we have the data visualization. This goes hand in hand with the descriptive statistics to get more understanding of the data. Then we have the predictive modeling aspect. So as you would see, so whenever we are trying to understand what is the expected claims cost, so we need to understand how the prices of the crop for a specific district, for a specific state would look like, say in a future 1 or 2 years. So that's how predictive analytics plays an important role. And then we have this corrective action and intervention. So if we identify that there is some anomaly which we are finding in the data, that could be things like non-seasonal patterns or sudden disruption in the data. So we need to have some corrective intervention to ensure that is also managed well. And then we have the post-intervention impact analysis. So after we do our intervention, so based on the techniques that we have determined, so we should also do the impact analysis to ensure that whatever projections or whatever interventions we have done, what is the impact of that, and that should not, negatively impact our entire analysis. So we should do that check as well. And we have pre and post comparison. So what was it before we did this intervention? What happened after we did this intervention? How were the results looking like? And then finally we have these results. And then we finally do the deployment. So we have gone through each of these stages. So I will not be able to discuss in detail what each of these stages is, but nevertheless, I will take you till the end stage, which is the deployment stage, and also run a quick video to see what is the model which we had built. And then we have various data science techniques. So we have things like classification, we have regression, we have clustering. So each of these techniques are important for us to understand various aspects of the model. Now say if you're talking about clustering, right? It's important to understand what are those clusters of various regions where we are seeing a similar kind of pattern, say whether be it fluctuation in the yield or fluctuation in the prices. It is important for us to cluster because as I mentioned in the AgMark, the data is very granular in nature, right? And we would not be able to use that granular. So we would have to form certain kind of cluster, create a homogeneous group, right? And at the same time ensure that between the groups there are high degree of heterogeneity, correct? So we ensure that there are these clusters created. And likewise for each of these models there is some application which is there, like classification is another thing. So we need to so we can have models which predict whether a particular crop would hit the MSP or not. So we have a classification model which also helps us predict that, so that we have a red flag early and then we can take corrective measures much before during our entire process. So likewise, we have a list of various models, tools, and techniques along with this process flow, which we go through whenever we are working on this project. Now talking about the data collection, so for each of these, so we are talking about 6 crops. So though we have, about 20 odds, more than 20 crops for which MSPs are declared. So we are just focusing on these 6 crops and for which we had collected data from AgMark. And there are about 30 lakh rows of data which we created across hundreds of sheets of Excel. And naturally, such big data is not possible for us to do any analysis in Excel. So we had to implement our Python and R-based approaches. So this is how the numbers look like across each of these crops. What was the year for which we had taken these? What are the various infrastructures and tools? Various concepts and methods which were used, various data management solutions which were used, so that we get an idea about, what are the various skills and various techniques which are required. And then finally, we have about closer to 29 lakh plus records which we are able to extract. So as you can see, so for some of the crops, right, say in chana in specific, so the prices, so for all other crops, you would see we were able to extract prices from year 2008 to 2019. But for some of the crops, we may not be able to do that because the MSP was not available for that early ages. So for whichever the data was available, which helped us do this entire analysis, those were the ages for which we had taken this into consideration. So the data has been analyzed and based on various parameters, right? For the following, these are the various calculations which we did. So we had price comparisons, model prices, then settlement prices, MSPs, future close prices, predictions, then quantity traded, how much quantity was traded, closing prices, and day to contract expiry at each of the transaction. So now we come to the next segment, which is calculating the expected value of claims cost, the liability part, right? So in order to calculate the liabilities, so essentially we need 2 things. One is the quantity, and the other is the difference between MSP and the prices. So we should be able to first predict what the MSP would be. So this entire data, entire calculation was for the data 2019. So we need to have the MSPs for the future years, right? So how would the MSPs look like for the future years? And not just the MSP, but also how would the prices look like, the market prices look like for the future years, right? So only that would give us the true value of what the expected liability cost would be. So this is a graph which just summarizes that. So the text might be tiny, but what essentially it contains is it contains the projection with the minimum and the maximum value towards the later end of the images you would see. So this gives us a range as to how much do we see the fluctuation in the prices based on the past data. And the methods which we have used in order to do this projection are the ones which I had mentioned in the previous slides. So apart from the price, we also need to project how the volumes would look like. So in the volumes you would see, so there is a seasonality aspect which is there because we are talking, so we had, while taking these 6 crops, we had ensured that there is a good amount of variation which is there. So we had taken about 3 crops from the Rabi and 3 Kharif crops, and accordingly we ensured that there is a good amount of variability which is there on the crops which are selected, and this is how the volumes projections look like. And then finally, based on the difference and the formula which I mentioned, so we had liability projection. So the formula which I mentioned was the best estimate cases, but apart from that, we also tried to give try to get an understanding of the other extreme cases. So what would the liability look like if the prices were, much lower than what our best estimate is? So our liability would increase. So how much would that be? Then there is a maximum liability. So along with the prices, if our volume projections were also on the negative side, how much is the maximum liability that we are talking about? So as you can see, the total liability for this 6 crop is in the range of about 20,000 crores to 40,000 crores. So that's the amount of variability, right? And whenever there is a variability, that's essentially, when translated into actual terms, is a risk, right? So that's the amount of risk which we are talking about the insurance company has. And that's why there is so much of repulsion from the insurance companies to have such schemes. That's where the government comes into picture to ensure there are proper interventions kept in place to encourage insurance companies to take such schemes. Now coming to the second aspect, so we talked about the claims cost aspect. And there is the second aspect which we need to discuss, which is the calculating the uncertainty and expected income, the cost of hedging strategy which we are talking about, right? We need to also discuss about that. But before we look into that, we should also see how are the derivatives prices moving, the data of which we got from the NCDEX, how is it moving along with the market prices, whether it is correlated or not. Because that gives a sense of relief that, okay, the prices of the futures are moving in line with the market prices, and we have better confidence in taking this as a strategy to move forward. So as you can see, for each of this crop, we have a very good correlation, and overall, if you see the correlation, it's about 90% correlation, which is considered to be a really good correlation, right? So with that as a background, so though I have this slide for each of the 6 crops, we'll just be talking about barley and then see how each of these 2 strategies are. So the very first strategy, so essentially there are 2 things which we can do in order to hedge this systemic risk, right? The non-diversifiable risk. So one is either we short futures or we buy put option. So shorting a future option would essentially means we are selling the right and the obligation to exercise a particular contract. So that is the way we are able to hedge the fall in the price of the risk. And the other aspect is buying the put option. That means we are buying the right, but it's not an obligation. So we have the right to exercise that particular contract at our will. If we feel that we need to exercise it in order to be at a better position, that is another strategy in which we can implement. So there are various considerations, calculations which we need to do, like the number of contracts, how many contracts which we need to get. So these are all theoretical numbers. In reality, the picture might be very different, right? So because it all depends on whether we are able to procure those many derivatives from the market, from the NCDEX or not. So that is also important consideration. But nevertheless, if we are able to get these many contracts and then we will be able to hedge the non-systemic aspect of the risk. And then there are 2 things. One is the initial margin, and there is the basis risk. The basis risk is essentially the risk of the prices not falling in line with the market risk. So these are the 2 ways in which we are quantifying the cost of the hedging strategies, and then we are moving ahead with this particular thing. So we have this for each of these 6 crops. Then we have for maize, we have for mustard, soya bean, and for each of these crops we have calculated what would be the hedging cost, and which brings us to the very final aspect, which is calculating the premium. So till now we had seen that we are talking about 2 things, right? In general, one is the claims cost. We calculate the liability aspect of it. The other thing is uncertainty in the hedging cost, essentially, right? So once we have both of these things, when we add it up together, that is what the premium we get. And we have various ranges of premium based on the liabilities that we had determined. The liability with the best estimate rate, the liability with the prices falling on the negative side, and then the maximum liability. For each of these, we have various kinds of premium. So this is the amount of premium which we need to have in order to get such crop revenue protection. So with that, I come to the very last segment, which is this working model. May I please request you to play that video? So this is the last 30 seconds. With that, we would be ending this session. So this is the working model which we had created. So it essentially helps the user to, so the calculation, whatever we had done, so it is all hosted online, and then it can be shared with the clients through a web link, and using which they can actually get a very good idea. They can also play around with each of these things, see for each of the crops across each of the states, how are the liability rates, how are the asset rates changing, and when they use various strategies like options and futures, how would the entire thing changes. So with that, I guess my time is up. Thank you all for your kind attention, and with that, I'd like to end my session. Thank you.
So that was a very nice session. Next we have Mr. Fani Krishna Kandala and Dr. Sathya to present on the reinsurance optimization portfolio steering. Yeah. Thank you, sir. This is forward.
Hi all. Thank you, Madam Chair, for giving a good introduction to us. And thanks, Satya and Rohan, for the enlightening talk actually before on the crop insurance, with the forum set for talking about the optimal portfolio steering on the casualty reinsurance, which is the need of the hour, with the changing economic environment and the volatility in the claims. We see actually there is an immense importance being laid for deployment of the capital, okay, in the right pockets. So that is the main objective, or basically that is the main vision through which actually we try to propose this idea to come up with an optimized portfolio steering for casualty reinsurance. It's an hybrid approach in the sense that we are using a quantitative analysis as well as a qualitative analysis to come up with an approach which is suitable. So now what I'm going to do is, I'm going to provide a short introduction, because I want to cater for all the audience here who had been experienced, who are emerging, to understand what is casualty line of business and what type of reinsurance structures that are suitable to casualty line of business. And I wanted to give an introduction about what is portfolio steering, why do we want that, and how we are going to address that particular portfolio steering as a subject. Then we would actually talk about the proposed framework, what we have come up with, and along with the theory, we wanted to actually present 2 case studies which are related to this aspect, going more granular and trying to explain each case study with both the quantitative analysis as well as the qualitative aspects, what we are going to consider, and then we conclude the topic from here. So, as I discussed, actually, I'm going to provide a casualty and reinsurance background and then portfolio steering. What we see in casualty as a line of business, we are going to actually compensate for the legal liability, mainly on the civil liability rather than the criminal liability, to pay the compensations in respect of personal injury and property damage, or property damage, we can word it of both. Again, I wanted to actually distinguish here the personal injury into 2 components. One is the physical bodily injury, and the other one, which has lately picked up to importance, is the psychological or the mental injury, which is also being liable for damage compensations being paid. Keeping this in context, we need to ensure that it is occurring during the period of reinsurance that is evident to all of us. Along with this, I wanted to actually introduce the lines of business which I'm going to consider as liability in the common parlance. One is public liability, the other one is product liability. The motor, as such, the third-party liability, bodily injuries, as we know, and the property damage is included. But for the classification purposes, we are going to talk about motor own damage also being included into this aspect. I'm going to talk in few minutes actually about the professional liability and the professional lines aspect and the workers' compensation. So these are the most important lines of business. The distinction, the most important distinction which I wanted to highlight here, although public liability and product liability appear to be very similar, they vary in the type of aggregation, in the sense that public liability has got more aggregation or accumulation scenario rather than the product liability. So with respect to financial lines, I wanted to categorize into these three windows. The professional liability, which has got some intersections with the management liability and the speciality of it. Now, what do I consider within each circles of each Venn diagram is, one, if you see on the top, we have the professional indemnity part, the errors and omissions part, which is generally considered within the professional liability, which has got the higher scope, being completely into professional liability. The other aspect which is interesting is the medical malpractice, which has got a component of the bodily injury aspects into it. The other one which I wanted to highlight, which is picking up, is the design and construct liability, which is again associated with the architects and engineers who are being advising the firms. Coming back to the management liability, we have got the employment practices liability, which is recently with the ESG's kind of a scenarios, okay, the climate risk and the social and the governance issues. This has picked up a great importance globally. Now, after the employment practices liability, I wanted to highlight through the management liability, the directors and officers. In the current and economic uncertain environment, we can actually see a big uptick with respect to this portfolio in terms of claims, as well as the volatility and the profitability associated with it, right? So then the financial institutions, it almost became actually like the insurance coverage is not possible on this line of business. But on this segment, especially financial institutions being actually the first party to get the class actions being rolled upon. So this almost became actually like an extant insurance criteria for most of the lines of business, especially in casualty. And the title insurance and other intellectual property insurance are also gaining importance, but I would actually rate the other lines of business to be more prominent for our exercise as seen today. With respect to casualty insurance, the reinsurance products, what we have got, although a basic one, I wanted to mention the proportional and the non-proportional products, what we are going to generally put it to the client or the cedent here. Quota shares are actually an important component, and in the quota share components, mainly the motor and the personal liability had been going into this quota shares. Recently, for the capital reliefs and the solvency purposes, people are going for an whole account quota shares, where all the lines of business are actually being shared in the proportional manner with the reinsurance. Surplus is almost not an important criteria for casualty reinsurance. The most important product what reinsurance generally have an association or relationship with the cedent is the non-proportional. And risk excel comes into picture only when we have got the global specialty clients, where you have got a bit of an accumulation, and this is where the frequency aspect kicks in. Otherwise, it's mostly the severity aspect which is important from the casualty line of business. But lately, what we had seen is clash programs are gaining an importance, especially the intra and interclash programs is very important to have a distinction and the coverage what we are providing. Saying that, aggregate excel is the most popular reinsurance structure, what we have got, and aggregate stop losses, I would actually put it in this criteria, and that is becoming again extant with respect to availability of capacity. Now, CAT Excel, I have seen only the motor and the employer's liability being going for this kind of an structures, okay? Otherwise, it is mostly the property-related aspects which I'm eager to listen for the next, from the next session. The facultative business, as such, is more on the general liability and the professional liability, okay, which we are going to discuss in the case studies, how they're going to do a portfolio steering on this at a very granular level, okay. So although the structure appears to be more riskier, it is, since associated with one particular risk globally, it is easy to manage rather than the treaty which has got more uncertainty. At the same time, we know actually the accumulations can occur through risk Excel of the faculty too. So keeping this introduction short, I wanted to start with portfolio steering. Now, in terms of portfolio steering, if you actually see what we want to achieve is basically getting an optimal risk selection. Now, this actually sounds very, very rosy or very nice on the paper, saying that, oh, we have got an optimal risk selection. But how do we get the optimal risk selection is the aspect. Are we actually trying to retain some risks with from the portfolio what we have got? Or are we going to actually avoid some risks? Okay. For example, what we have mentioned about the D&Os and the financial lines or the financial institutions? Or are we going to actually go for an opportunity where we have seen like a mix of proportional and non-proportionals where we are getting a better return? Are we doing that? So that actually is coming into what for me, because we need to understand how do we steer portfolio through these aspects to get the optimal risk portfolio selection. Now, why are we doing it? So as I addressed before, it is the capital efficiency purposes. The main important aspect is capital efficiency. Along with that, actually, we get bit of an benefit through doing a capital efficient allocation is the diversification. So including the diversification, if we see, we are going to actually offer a better solution to the client. Okay. Always we say we wanted to put client at its center. At the same time, it is not always possible. It is a cliche by saying putting client at the center, by not actually having an optimal risk portfolio will always be an insolvent company result. Now, how we are going to do that is basically we are going to start with a current in-force portfolio. We are going to talk about the market outlook and trends, which are important in the current market. And then we are going to actually talk about the company's strategic priorities, what each reinsurance company might have from the casualty perspective. So this is the proposed framework what we have come up with, which has got a hybrid approach of quantitative analysis as well as the qualitative aspects of each casualty portfolio. Definitely, we are going to start with a current portfolio allocation, what we have got. And we understand through the current portfolio allocation what is good and what is an opportunity or basically what risks we can avoid. From the thing, actually, we are going to do a quantitative analysis from the exposure perspective. Now, what do we mean by exposure? Exposure is such a loose term in the sense that we can actually call the external data and the benchmarks to be exposure. At the same time, we can call actually the risk, which is being in the certain conditions, to be an exposure. So the type of analysis what we are going to produce is a combination of both here. And then we are going to talk about the quantitative analysis from the experience perspective, which we all actuaries are more involved with, coming up with the frequency severity assumptions, trying to come up with the ultimate loss costs, and trying to understand what would be the ultimate loss cost which would impact the company. Along with this, actually, we need to come up with a current capital allocation too. In the sense of current capital allocation, how much should I allocate to the public liability, or basically how much should I allocate to a particular region, or how much should I allocate within the subline of business, such as construction liability? Let's take an example. So these are the quantitative or estimation aspects what we can actually do. And for this, we can use a statistical approach, we can use a data science approach. It can be a parametric approach, or it can be a non-parametric model what we can develop. We can do a time series analysis because it is more actually a time-dependent aspects too. Okay. By actually understanding a bit more on the quantitative, there are about the qualitative aspects too which we need to take into consideration. For that, we need to understand the next layer level, which is like inflation trends. Inflation has been a hot topic actually if we see in the last 2-3 years. Economic inflation has been a great hit. Along with the economic inflation, the interaction impact on the social inflation has been more higher. When I say social inflation, again, we can define and we can actually have an entire 1.5 hour session only for the social inflation itself. But I would actually highlight 3 things. One is the nuclear verdicts, what we are seeing from US, which is being spread over the other markets too. And one judgment can actually lead into a benchmark for all the other judgments, even though it is not a big compensation what we need to be paying there. Along with the nuclear verdicts, what we are seeing is the attitude of the behavior of the claimants and the plaintiffs. and the claims farming or claims harvesting issues what we are seeing, like a no fee, no gain, no fee, no win kind of an approach is what people say, take. So including that, we need to understand what are the emerging risks and the opportunities associated with a particular line of business. When I say emerging risks from the casualty, the things which are coming up is the silicosis, or basically anything which is related to PFAS, which we are not knowing, but we are actually getting exposed each and every day, including this environment where we are using that plastic water bottles. So for drinking water here, okay. So keeping that into perspective, we need to come up with a model, okay, using the quantitative aspects what I have discussed. Still, qualitative aspects come a next level to me. First, by quantitative analysis, we need to come up with an optimal predictive portfolio. Once we have come up with the optimal predictive portfolio, we need to understand how much capacity we can allocate to each line of business what we had discussed, and then come up with a diversified portfolio. Now I'm getting the diversification into that. So once we have got an optimal technical portfolio, okay, which is like equivalent to technical price what we see as an actuary, from there we would develop an office premium, right? In the similar way, we need to actually understand the competition. In the sense, here the competition is not the usual competition what we see from the insurance perspective. I wanted to highlight actually from a reinsurance lens, you need to understand whether aggregates are being offered by the other market, because it is always like a co-insurance. You are going to share a particular risk, okay, a particular treaty or a particular facultative with X number of insurance and X number of reinsurers. You need to understand actually what the leader is doing and what the following market is going to do. So in that sense, actually competition becomes more important, and you might not actually achieve what you wanted to achieve with your technical portfolio. Along with the competition, I would highlight the market cycle. In the current scenario with natural catastrophes and the pandemics, the market became harder, and it is really kicking in more harder. But when we actually have a soft market, okay, we cannot really get our optimal technical portfolio being implemented directly. So this is another part which I wanted to highlight here from the market cycle aspect. Once we get the market cycle aspect into thing, we need to understand what cross-subsidies and relationships we are going to maintain or we are going to see. Because reinsurance market is basically, I use one of my colleagues' quote, better relationships make better business. So relationships with the clients is very important here to understand. Although these are softer aspects, but these actually make a bigger impact in terms of coming up with the right deals or right portfolio here in that sense. So once we have understood actually with whom we want to maintain the relationship and with whom we wanted to actually use the cross-subsidy as a leverage, in the sense here, property and casualty is the cross-subsidy what I'm talking about. Every time casualty is always taking a hit because of the property sometimes, okay? I'm being a bit more an argumentative statement here, okay? It is like 80-20 to 60-40s all times. So that's why actually it is very important to understand what type of cross-subsidy we are getting and what is the optimal portfolio we can achieve, keeping property also into perspective here. Once we do this, we are going to get the future portfolio here. And it's a cycle. Future portfolio becomes the current portfolio for the next year allocation. It can be 2 years allocation, it can be a strategy of 5 years. It depends on what we want to do. Now I wanted to highlight the qualitative aspects which really goes into this future portfolio apart from the capacity and competitive pricings which we already spoke. Terms and conditions is very important to keep the coverage very robust. If we are, for example, take the pandemic as an exposure. If we did not have a Biosecurity Act 2015, okay, so the test cases, what we had seen globally would have been failed and the business interruption type of losses would have been paid. And at the same time, what we are seeing off late, the recent trend in the casualty is the silent cyber. It appears to be a very good jargon, but actually a person who is not having a bodily injury and having a mental injury is being covered is something which we don't want to see as an exposure. So that's a kind of a silent cyber issues would be addressed through terms and having a tighter terms and conditions. Then comes the coverage aspect. Are we trying to increase the deductibles? Or are we trying to maintain the same limit? What are the type of clauses we want to keep for the same coverages? That's very important to understand. No need to say actually that KPIs make a big impact with respect to company strategic priorities. Now, keeping this into perspective, I wanted to take an example where we see actually a construction liability. Since I'm working in the ANZ market, I would actually take through the numbers on how we have done actually an optimal portfolio selection through the construction liability. In the construction liability, the type of risks what we had seen, just to let you know, I have divided this analysis into quantitative analysis, where we want to see the numbers, and the qualitative aspects, what we had considered as posing risk from the coverage perspective. These are the 6 KPIs, right? Every time we wanted to see in any of the type of analysis what we want to see, what we are going to perform. One is the premium. What is the premium I'm going to charge? What is the growth? What is the rate change or the trend what I'm observing with respect to the rate change? Can I actually differentiate between the growth and the rate change? How much of it actually has come because of my increase in the limit? So we need to be aware of this, but at the end of the day, when you're putting on the Excel sheet or in your R or Python codes, what you're going to do is like these metrics from exposure perspective. And needless to say, actually, from the claims perspective or the experience perspective, you wanted a frequency, a severity, and a loss ratio at the end of the day. Yeah, it might differ actually if you want to think about just the severity and come up with a burn cost. That's a different aspect, but I would say that these all play a big role in coming up with the quantitatives. And these are the things which we can use all the data science aspects or basically actuarial estimations and other things what we mentioned before. Now, coming back to qualitative aspects or the qualitative considerations what we had taken. From the exposure, we have divided into, it's not always actually a risk. There are opportunities also along with a particular line of business. In this case, if you see the emerging risks, what I wanted to highlight here is the contract and labor hire personnel. This is a famous one actually globally, what we are seeing as the worker-to-worker exposure, what we have got, where there is a subcontracting and liability associated with the subcontracting is being exposed. Along with this, actually, what we are seeing is a cladding, and this is very important. So the example is pretty much relevant to Indian market with the growing infrastructure. So that's why I have chosen the project the single project professional indemnity and the construction liability as actually the case study examples. Now, cladding has been a big issue across the globe, and we are going to see that kind of an impact. In fact, actually, we have seen some claims with the lower penetration in the insurance and reinsurance market from casualty perspective. This will not be a big surprise if we see claims associated with respect to combustion cladding very soon. And along with that, actually, the construction defects and the rectifications. Who is going to take the liability? Is it the government, or is it builder, or there will be an association or the pool which will be formed to take up this liability? That's another aspect which we need to understand. After taking this, we need to understand actually how the cyber is impacting. Will there be an technology, semiconductors, or the basically sensors which are involved, and how much it is going to impact each of the risk what we are going to consider, and what is the risk profile mix what we are thinking about. Now, once we have got the cyber and the pandemic aspects into considerations, I wanted to see like what are the opportunities which are there. Now, are there some opportunities? Yes. If we have got a long-term player and a stable financially stable construction agent, then we can actually go ahead and think about writing that construction liability or providing construction liability insurance from primary market, thereby reinsurance market. Now, after this, from the qualitative considerations, I would really think like, through the parameters, how much can I estimate through quantitative aspects too? For example, inflation. Do I have some GDP indices which is providing me some indication about how much my inflation is? Definitely, I would come through claims cost from my own portfolio, but do I have a benchmarks allocated with it? Or do I have the similar geographical regions which gives me that inflation assumptions? And how can I differentiate between economic and the social inflation aspects which we discussed before? Class actions has been a thorn in the flesh with respect to casualty reinsurance. Class actions is gaining a lot of popularity, especially with the litigation funders supporting that class actions and funding that class actions directly and legitimately. And of course, construction defects and rectifications are something which we need to keep into our picture. More on the contractor injuries and the nuclear verdicts we have already discussed before. So I would actually think like, what will be my portfolio steering output after taking this into considerations? I have taken quantitative and qualitative aspects. Either I would reduce my capacity or increase my capacity. In this case, I would reduce my capacity because construction liability is having loss ratio of 80%. I would definitely increase my deductibles to ensure that there is a skin in the game from the insurance perspective too, okay? Because we cannot actually entertain without being skin in the game in this. So then I would either increase or decrease premium. In this case, it may be neutral or it may be an increase in the premium and the terms and conditions in the coverage. The second case study, which will be a bit shorter one, because it's more wider in terms of the scope, is the financial lines, the single project professional indemnity. The quantitative analysis does not change much. It'll be the similar one what we had seen from the previous case study. Now, what we are going to see do the quantitative analysis of the claims history's usual inflationary aspects. Now, the qualitative considerations where we can take the data, I have put it in the quantitative analysis here. But the most important aspect is the qualitative considerations for a single project PI. We are going to actually concentrate more on the risk engineering aspect when it comes to a professional indemnity from a project perspective. The things which we need to look into the limits, what we are deploying, the length of time that particular contract is, and how much we are going to put as an attachment or deductibles with respect to this, and how they would become more material from an exposure perspective. Thinking about this, okay, what is the experience of a contractor? And are they having some joint venture partners? How is the regulation in the market? Are we actually seeing some geolocation? These aspects we need to be considered when we are actually thinking about providing a single project professional indemnity coverage. Taking this into aspect, the conclusion would be, from the two case studies would be, the portfolio steering should be an appropriate capital allocation strategy. It should be actually providing some financial stability. And also it should actually steer an optimal portfolio selection. Efficiency is one of the important criteria for every business. Keeping that into picture, we need to get an optimal portfolio for each and every company so that insurance companies would grow much higher in terms of 2047 goal, what we have got. Thank you.
Thank you, Mr. Funny. That was really good, and thank you for the great insights. Now I would request Ms. Ruchika Sangwan and Ms. Tanushree Gupta to talk about reinsurance optimization for non-life insurance.
Hello everyone, and what a wonderful session on reinsurance, portfolio steering and crop insurance. I hope everyone is soaking up all the information that has been shared by on these topics. I'll not take too much time as I keep seeing the person showing the timer on the right side of my thing, and I'll pass on this to my colleague Ruchika, where we'll try and talk about what is RI reinsurance optimization, why we are talking about this. What considerations when we are trying to understand we need to put when we say reinsurance optimization. And what we have tried to do is try to explain this through a simple example from a property book. But most importantly, what we'll want to cover towards the end is the outcomes from that, how to interpret, how to read when we're talking reinsurance optimization. And like I said, I'll not take too much of my time and give it to Ruchika Sangwan to talk through on our topic.
Thanks, Tanu. And thanks a lot, Fani. You've made my life a bit easier by introducing a lot of concepts here. So not spending too much time on what reinsurance is, which is typically the route I would have taken had Fani not been kind enough to introduce all these concepts. I'll just delve straight away into what is reinsurance optimization, why are we first doing this, what are we discussing, what all to consider, and from an actuarial standpoint, in our day-to-day jobs, how can we actually carry it out for it to lead any optimal solutions for the business, and how it can then inculcate into the whole business strategy. As part of the presentation, we've also built in a small, very simple example, sort of like an Excel-based calculation for you to kind of understand and get a flavor of what essentially we're trying to do and how you can actually conduct something and, let's say, undertake this within your companies as well. So I'll just start off with what is essentially reinsurance optimization. So like most of you would be aware, reinsurance typically ends up being one of the key significant components, or let's say the cash outflows for a business from an insurance company perspective. And then it makes very much sense that the business is also trying to understand whether or not we are getting value out of it. So that's essentially the whole concept behind reinsurance optimization. What we are trying to achieve out of the exercise is to come up with an optimal solution in terms of reinsurance purchase, which can actually help the business. Now, there are some key considerations that we have to be mindful of when we are going ahead and purchasing reinsurance. And even while conducting a reinsurance optimization exercise, we have to be always mindful of these considerations, because obviously that must have been the criteria, or let's say the strategy with which the business must have gone ahead with. So first and foremost, we have to understand what the need for reinsurance was. Now, this can definitely vary depending on what the idea is. So it could very well be regulatory driven, or it could also be driven by the fact that the company is trying to, let's say, increase their capacity, or let's say they want to get some technical expertise from the reinsurer. So we have to be mindful of the need as to why we've kind of arrived at the solution that we currently have. The next is we have to be mindful of the products as well as the lines of businesses that we are dealing with, because typically within the P&C space, we must have seen that your reinsurance structures typically vary depending on the products at hand. So the reinsurance structure, or let's say the amount of reinsurance you're purchasing for a property line of business vis-a-vis a motor line of business might turn out to be very different. So that has to also be kept in mind while arriving at an optimal reinsurance solution. The type as well as the level of coverage. So what I typically mean by type is, if, let's say we are talking about a property line of business, are you currently engaging in a mixture of surplus, FAC, risk XOL, CAT XOL, and do you want to move towards, let's say, a different sort of a structure altogether? Similarly, the level of coverage that you have, the total cover that you're buying currently, how that has to change in line with the business strategy that you have for, let's say, the next future year, that has to be kept in mind as well. Availability and cost, obviously, the key criteria. We might be very creative and come up with optimal solutions, but they have to also be practical in the market. And what cost are they coming up with? Because if, let's say, we are proposing a structure to the business which turns out to be less cost effective, then no point of doing that in the first place. Here, like I said, we are trying to basically evaluate different reinsurance strategies. So you are, let's say, going to start with a current portfolio or a current strategy, and then what you're doing is essentially a cost versus benefit analysis, keeping in mind multiple structures and then just trying to evaluate which one fits best. And last but not the least, what sort of business implications do they have from a qualitative, quantitative, as well as a long-term and short-term view. So like I said, it's a cost versus benefit analysis. So while the reinsurance strategy change might be coming up with, let's say, an increased cost, or the opposite side of that, which is an increased profitability, how do I weave that in within my business strategy to make sure that everything is actually flowing through together and it's well aligned from a business perspective? So these are some of the key criteria that we have to always be mindful of when we are conducting such an exercise. Now, the next thing is, why do we purchase reinsurance? And I'll just briefly cover this. The first criteria, or the most important criteria from a P&C perspective, why we go ahead in the market and purchase reinsurance, and more so for newer companies or newer lines of businesses, would be to create capacity, for us to be able to write larger risks or more business, vis-a-vis trying to manage the maximum losses that we can get out of that portfolio. So it could be a single large loss as well, or it could be an event loss as well, which is quite common in terms of catastrophes for property business. So keeping that in mind, we want to, obviously, every company would want to write more and more business, but while we do that, obviously, we want to ensure that the risk that we are retaining within the business is not so much, and that becomes a key criteria from a reinsurance purchase perspective. The next is stability. Now, I don't think there will be any insurance company who would like to have a lot of variability within their P&L. So that becomes another key criteria. Like from a PNC perspective, most of the companies, the reason why they engage in a lot of CAT reinsurance purchases because they want to avoid the fluctuation that might arise on their P&Ls or in terms of their profitability as part of not having reinsurance, let's say. So that's one thing that we want to avoid. And obviously, the regulatory restrictions have also to be kept in mind. Like for instance, in India, we have this 4% minimum reinsurance cession to GIC. So that is obviously there. But apart from that also, we have to be mindful of what the reinsurer typically expects or what kind of structures can I potentially go ahead in the market with and get an okay from the reinsurer, so from the regulator as well. Then financing, of course. Typically for newer companies or newer product lines, we must have seen that the new business strain or just the possibility of premiums not being adequate enough to meet claims as well as expenses, commissions that arise out of it in the initial years, it might make more sense for the business to go ahead with some reinsurance just to ease out the cash flow or liquidity issues. And another thing is, of course, as part of reinsurance, given you are parting or let's say passing the variability from your book to the reinsurer, it automatically means that from a capital perspective also, you're getting some relief. Then services, like I said, any technical support or any technical assistance that you're getting from the reinsurer in terms of underwriting, claims management, business management, etc., that has to also be kept in mind. Now, here, obviously, the idea behind whole reinsurance is to balance the two objectives. So one is obviously the solvency of the company, which automatically ensures that your policyholder needs are met. Alongside that, you're also trying to evaluate what your shareholder needs are, making sure that in terms of shareholders, you're also trying to generate the return on equity that your shareholders would typically expect. So we are basically trying to balance the two aspects together, while ensuring that all the risks that we have kind of taken on board in terms of my gross exposures after allowing for reinsurance is within my risk appetite. Now, why do we optimize? And what we are essentially trying to do here is balance. We are trying to arrive at a balance between how much profit am I ceding? Because obviously when I'm parting away with a part of my business, I'm also giving away my certain aspect of my profitability as well. But at the same time, I also want to ensure that my risk retention is within my risk appetite. One side of that is if I have too much reinsurance, I am literally ceding away a lot of my profit to the reinsurer. And the other aspect of that is if I'm having too little reinsurance, that automatically means I'm carrying excessive risk, which might lead to an increased risk of insolvency for the company. So what we are essentially trying to do here is we are trying to arrive at an optimal balance. Now, what to optimize? I mean, an easy answer is the program cost. Obviously, we are trying to minimize our spend in the sense that not a lot of profitability is going within the reinsurance purchase itself because it comes at a cost and there is a margin that you're ceding away. However, it has to be balanced against the profitability that you're keeping within the business. Because while from an analysis perspective, it might be done very deterministically, there are a lot of moving parts when we actually get to reality. So it is very crucial to ensure that while you're looking at the program cost, you're also looking at what kind of profitability are you going to get to keep if you, let's say, move to a more optimal position. The next is obviously regulatory restrictions. You have to be mindful of what the regulator might come up with or what the pushback or challenge from the regulator is going to be when you go ahead and propose this alternate strategy. The variability within your returns. So again, you have to undertake the analysis from a P&L perspective, from a solvency margin perspective. And while we are doing that, a short-term and a long-term view both have to be kept in mind. And last but not the least, what capital relief or benefit you are getting from the RI structure. So we are all aware of the solvency calculation that we have. And obviously, there is a credit that you get as part of you having some reinsurance on your book. So let's say we are moving to an alternate strategy wherein it leads to an increase in my risk, and therefore my capital also increases. Now that capital has to be funded through some other means. What cost is that going to happen at? Like, let's say if you're going ahead with borrowings, what's the borrowing rate going to be like? That has to also be evaluated. Similarly, the other option could be that you're going to increase your shareholdings. Now, what sort of return would your shareholder then expect on this additional capital that you're intending to raise? So basically, at what cost is this new capital coming in? And then again, like I said, your expected outcome, your tail risk, as well as your year-on-year variability has to be evaluated, and making sure that it's all within the risk appetite for the company. Now, how to optimize? And this is where the actuarial teams, I feel, can play a very big part, because primarily this entire calculation should and can sit within the actuarial framework. So you can typically start with a 4-stage process, wherein you start evaluating your data. So the idea here is, obviously, we are coming up with a reinsurance structure. So we are trying to evaluate a potential structure which can work for my next future year, let's say. Now, what can be a better guide for me to arrive at, let's say, a view of my claims than to rely on my data and then keep overlaying any subjective assessments or judgments from my business experts? So you start off with data, then you move to an assumption setting exercise. You can undertake a simulation modeling, or you can do a scenario-based as well. It completely depends on the comfort of the company. And then it finally flows through to decision-making. Now, this is a 4-stage cycle. There are 2 key aspects to it. And like Fani said, a lot of the analysis would be based on a quantitative assessment as well as a qualitative assessment. So starting off with a quantitative assessment, you'll typically conduct a gross analysis. An easy example for, let's say, the fire portfolio would be to, basically do a split of your business and try and assess what my attritional claims experience typically looks like, what my large losses look like, what my catastrophe book would look like, and try and evaluate how much variability is inherent for you to understand how can I go ahead with this optimal structure, and how can I basically assess the variability for each of these parts to make sure that the reinsurance that I'm purchasing literally caters to it in the most optimal way. The next would be to undertake pricing aspects or your pricing considerations in mind. So what is your underwriter telling you? How do you think, let's say, the insurance market is going to behave? Are you going to move to a more profitable position just because the market cycle is such? All these aspects have to be weaved in when you're conducting this analysis. Next would be to carry out an impact analysis once you've literally projected your gross business and then try to overlay it with your insurance assumptions, assessing essentially the impact of these different potential structures. It could be just a change in strategy as well, wherein you're just playing around with numbers. However, it could also mean a full-blown exercise wherein you are literally changing structures and, let's say, moving away from a position where you were doing surplus plus FAC to, let's say, something which is a simple quota share, or let's say a mix of quota share and XOL. Profitability as well as solvency, the impact on both has to continuously be assessed. And last but not the least, benchmarking. From a benchmarking perspective, what are your competitors doing? How the assumptions for different strategies, they have to be consistent in the sense that that's the only way you can ensure that the results are meaningful for you. So let's say if I'm taking an assumption that my gross rates or my gross rates would typically see a reduction, let's say, of 10% in the market, then I have to ensure that this 10% assumption has been weaved in from reinsurance as well as insurance perspective, both in both my strategies, to ensure that I'm not missing out on anything and the results are making sense. This takes us to the qualitative analysis. So the first and foremost is management view. What is your management wanting to do? What is your position in the business cycle? Are you in a profitable position? Are you in a loss-making position? And hence, how risk-averse do you typically expect your management to be? Similarly, if, let's say, the management has a preference for risk retention, which is typically something that you'd see when a company is moving from, say, in its initial phases to a more matured phase, you typically see companies expecting to increase the risk retention. So is that something that the management wants to do? And what's the motivation behind it? That has to be fed in, because that will ultimately determine the strategies that you're testing. Then again, market movement, like we took the example for the rate change from an insurance perspective. We can see that reinsurance market also, it might not coincide with the gross or the direct market. However, reinsurance market would also typically have a similar sort of a rate cycle. And what is that looking like currently? So are you, let's say, everybody's been talking about, how globally the reinsurance rates have been increasing. So if, let's say, the global market from a reinsurance perspective is moving to a harder market, do we typically expect that to happen in our country as well? Which can automatically determine that the reinsurance rates you're expecting to increase over time, and hence more of a need for you to optimize your reinsurance structures. The next is treaty placement. I actually heard this from some colleague of mine who basically said that it's as much as an art as it is a science. So you have to basically keep in mind what the market capacity looks like, what sort of negotiating power do you have, and make sure that any quantitative analysis that you have conducted at your end also flows through to the reinsurer for you to help with these negotiations. And last but not the least, your peer benchmarking, your previous year's benchmarking, any expectations that you might have in terms of the results, any expectations that, let's say, your business has from the results, that has to also be fed back into this entire loop. Now moving on, this is a very simple example, and through this example, what I've tried to do is to provide you a flavor of what all can you keep in mind and how the outputs might look like when we do a reinsurance optimization exercise. So it's a very simple graph, and what it's trying to demonstrate is what's the likelihood of losses in different cases. So if you look at the purple line here, which is basically trying to give you a view of something wherein, for a line of business which has basically no reinsurance. So as a very simple example, what I've tried to do is I've tried to generate a distribution with a mean of 100,000, a 40% variability using a log normal distribution, just to give you a view of how adverse the claims can get. Obviously, around the 50th percentile, that's where you'll see that it's closer to 100,000. 100,000. So that's typically where the mean sits. Anything lower than the 50th percentile is basically telling you that you are going to have a favorable movement in your mean, from your mean. So kind of giving you a view that while at the planning stage, you thought you can encounter claims worth 100,000, your business might actually turn out to be more favorable than that as well. And then obviously the other side of that automatically means you're getting more adverse experience to come through. So the purple is basically giving you a view of what would happen if, let's say, you had no reinsurance. Then the yellow is essentially wherein you bring in a quota share arrangement into picture. So as you can see, the curve kind of shifts down, which is simply because as a quota share arrangement, you are essentially saying that a portion of your claims are going to the reinsurer, but it doesn't really change the variability of the overall curve. The other alternate structure that we've tried to evaluate here is an aggregate XOL. And as you can see on the pink line, it follows the gross line to a large extent, but as you move towards the extreme percentiles, it becomes flat. So that's essentially the part wherein your aggregate XOL is coming into play. And then it increases again, simply because aggregate XOLs will also come with an upper limit. So that's literally the part wherein the claims start falling back on your net account again. So this is just one aspect of what to undertake from a reinsurance optimization perspective. Now, extending it further, what we've tried to build in here is essentially something like an underwriting result for a fictitious line of business. We start off with 200,000 worth of premiums, carrying on the same example from previous slide. So assuming a 50% loss ratio, which translates to 100,000 worth of claims, there are some expenses going in, some commissions going in. We've also accounted for the 4% GIC recession and allowed for a 15% RI commission on this. So that leads to a 47,000 underwriting profit for me. Now, because we are trying to evaluate multiple strategies, the next part would be to consider an alternate or optional strategy wherein the company, in addition to the 4% GIC recession, they also write a 40% voluntary cession here. As you can see here, the premiums basically increase simply because you're ceding further as part of your voluntary quota share arrangement. And alongside that, your commissions also go up. Your RI commissions that you receive from the reinsurer go up simply because you are getting some return back from the reinsurer also. Now, if you were to just look at the underwriting result, it just gives you a view that maybe, retaining everything with me is the best idea simply because more profitability stays with me. Now, another example is to go ahead with an aggregate XOL. Similar sort of calculations, just that apart from, from a reinsurance perspective, what we've built in here is the 4% GIC recession, and we've kind of included an 8% premium cession to the reinsurer as part of this XOL arrangement. No commissions have been assumed. Again, similar to the quota share, if you were to just look at the underwriting results, it gives you a feeler that retaining everything with me is the best strategy. Now, again, like I said, profitability is one aspect. You have to also evaluate what's happening from a solvency perspective. So we go into the calculations here, calculate our RSMs, assuming that I am maintaining a bare minimum 150% for this line of business. Let's just, for the sake of argument, assume that we are doing it at a line of business level. We allow for some capital here, and then obviously because that capital has to be serviced, we are assuming a cost of capital rate of 10%. Now, because I have to service that capital, this cost of capital essentially goes out of my business. So, in a sense, what I'm left with is my underwriting result after allowing for this cost of capital. And again, after looking at all these numbers, it gives me a view that retaining everything within the business is still the best strategy for me. However, if I were to not just go by a formula-based approach, and let's say arrive at a risk-based approach, how would the numbers typically change? So here, from an example perspective, what I've built in is assuming a 99.5th percentile view. So what it is typically saying is that you are assuming that the business wants that the probability of ruin for this line of business is only 0.5%. So these numbers have been derived from a WTW software. And what it is basically saying is, as you can see, when you have no reinsurance, the capital that you need to block for you to ensure that your ruin probability is maintained is a lot higher when everything is lying on your book. Now, allowing that angle, it automatically gives you a sensible answer wherein it says that an aggregate XOL might have been a better choice. So you don't really need to think about quota share. And from a business angle perspective, you go ahead with a 4% cession, and you can buy an aggregate XOL strategy, aggregate XOL reinsurance. So this is just a simple example, which can obviously be extended to include further strategies, further lines of business at a company level, for you to evaluate where you want to steer your portfolio towards. And lastly, some additional inputs, insights, or outputs that you can derive from such an analysis is to also drill it down further. So you can typically assess what your contract utilization probabilities are. So this sort of an analysis typically helps with, let's say, your XOL purchases. Over there, you have the provision of reinstatements. So basically, essentially trying to restore yourself to the former position before you incurred a loss. So what you can do is, for each of these structures, depending on how many reinstatements you have, you can try and assess and extend the analysis further to see what are the chances of utilizing those layers, and then accordingly tailor it for your future strategies. And lastly, the analysis can obviously, once you're conducting it at a total portfolio level, can be extended further to help with your portfolio management and your business strategic decisions, and try and basically assess, if I have a business plan, what are my chances of meeting my business plan? What are my chances of, let's say, falling short of my solvency capital? What are my chances of paying my dividends? So on and so forth. So from an analysis perspective, the users can be huge, and this analysis can be easily extended. Now my time's up. He'd raised the red flag long ago. So if there are any questions, please feel free to ask.
Thank you, Ms. Richika and Ms. Tanushree, for taking for talking in detail about the need for reinsurance optimization. It was really great. Now we are open for the questions. I hope everyone had already added the questions on Slido. If not, you can still do it. You can use the code on the screen or use the hashtag to submit the questions. Over to you, ma'am.
Yeah. So actually, there are some questions here on crop. One of them is, how would you ascertain the minimum threshold level in case of crops where MSP is not available? How to handle speculation? And does the Government of India really support MSP? Is there a mechanism to buy complete produce, or Government of India starts and stops buying produce when the goal is met? And how is it thus limiting its liabilities, and how do we go about it? Then I think you could relate this with my question on, how do you get data for commodities which are not on the NCDX? How do you check the credibility and the validity of data that's available on NCDX? And what are the regulations affecting this kind of a product proposition in India at the moment?
Yeah, so a lot of questions, so I want to go with a single answer for most of the questions. So this is the beginning. Today we don't have anything like this. So to start with, what crops are actually being, like the derivatives are traded on NCDEX is the starting point. And for those which are not having any MSP declared, so the best way is actually to look at actually the past data of many years, which is available in AgMark. So MSP is declared for 22 crops or more, but like the data of each one of them is actually available in AgMark. But there is other way of looking at things also, like these crops which are actually declared MSP, they are actually the major part of it. So if we can address this part of whatever is properly arranged now, that itself actually should bring down the government's liability of 25,000 crores every year. So looking at the other one, like what type of regulation actually, so it is, because we are crossing multiple regulatory bodies here. One is actually the NCDEX, actually it is governed by another regulatory body. Insurance companies are governed by another one. So then there are, the main thing is actually insurance companies are not allowed to actually invest in derivatives here, right? So that's why actually in the beginning I mentioned it's a revenue protection. It can be done in an alternative way. That's how actually we suggested how US market actually came up with standard products, where actually the RMS is the one which is actually doing. So something similar can be actually brought up here. So where actually a standardized way of doing things is there. And without reinsurance, this is not possible, right? So this, the amount of risk actually it brings up is actually humongous. But one more question I saw actually where how it takes care of the notional yield. So yield protection is taken care by the Fasal Bima Yojana, where actually most of the natural calamities are there. When yield thing is actually triggered, then that means actually lesser yield if you are getting, then automatically the price shoots up. So then there is no way the revenue protection product, if both are in action, only one will get triggered. Very rarely you will see actually both the products getting triggered. Okay, how a life insurance and pension, one of them will get triggered, not both. In a similar way, here also revenue protection or the yield protection. These are so it's a natural diversification that is happening. So currently we don't have the revenue protection. That is where actually it's a good beginning for us. So this project is with the numbers we provided. So that's where actually, and then whatever actually is not taken into consideration whenever you're looking at actually some of the aspects of the calculation is not taking the assumptions related to the how much of the quantity government is taking or how much of is getting insured. So in our scenario, government is actually not able to take entire quantity that is produced. So that is the real reason why we are looking for a solution here. So because there is an intervention, but intervention is not really supporting everyone. So that's where actually it's a need of the hour that actually, because it's a sentimental thing also, like the farmer feels deceived when suddenly price falls. If it is a natural calamity, he's fine, he understands. Flood is there, inundation is there, they understand. But when the farmer feels deceived, that is where actually it may lead to more number of suicides, which is actually, so as a profession, we can actually add great value by coming up with a solution. Need not be insurance regular way. It can be a combination of various things which are currently available in the market. So that is where actually our entire effort is going. So to protect farmers from losing their entire investment, that's where actually the solution is being proposed. Thank you.
Thank you. Now with regards to liability insurance, I would like to, and casualty reinsurance, I would like to know what are the types of data that we should be collecting so that we, in the long run, we are adequately prepared, and what is one of the major role of a reinsurer to innovate and bridge across technical expertise available globally in this field?
Sure. Thanks for the question. Firstly, about the data. We need to think about two aspects. One thing is the data related to exposure. The more the understanding about the risk, or the more the understanding about the client, or the more the understanding about the business, what the cedent is doing, we are going to get actually the right information and we can take a right decision. This is more at a high level. When it comes to granular, because we are actuaries, we want to see like, okay, you have told the high level what data you wanted to collect, okay, from a granular perspective. I would think about the risk profile, the occupation mix, and the type of limit of indemnities what they are putting by region, and also by the class of business. Okay, if we are taking only one class of business, it is more actually the type of risk profile mix as well as the limits what they are putting. I already mentioned the limits, right? So from the claims perspective, I would be thinking about the claims mix, the status of the claim, which unfortunately generally reinsurance data will not have, and the threshold at which we get the limits, we get the losses, is also very important. Ideally, we wanted actually the threshold to be as lower as possible for the claims data to be provided, but at the same time, it's a cliche. We are not going to get that as far as we wanted. From the role of reinsurance to insurance, one thing I would really think is the technical expertise. Definitely, that is an added advantage. At the same time, I would think a collaboration between insurance and reinsurance apart from technical expertise. For example, having a common data pool or discussion about the emerging topics, okay, like just what we are doing now. We're understanding the type of clauses, what we need to push, what kind of ESG scenarios it might click. For example, the thermal aspects are there in the market, the silent cyber, the pandemic type of risk, how it is going to create an accumulation. So these are the aspects which we need to have an open discussion, transparent, open discussion, and come up with a consensus. That would really help us, crystallize role of reinsurance into that. Yeah. Maybe from property, I would hand it over to Ruchika.
So again, from a data perspective, I guess the points that Fani mentioned, they are quite similar. It's just that from a property perspective, given the reinsurance structures typically cater to different portfolios or different claim types, so typically storing transaction level data for you to assess whether or not your XOL is adding value is key. Similar sort of a consideration would apply for CAT XOLs as well. So ensuring that you have enough data available with respect to the historic CAT events that have happened, any business judgment, whether or not you expect those sort of catastrophes to happen in the future, or let's say, even if you expect them to happen, what return periods do you typically evaluate your business to be assigning to those historic events? Again, RMS, a lot of companies go ahead with RMS results for them to understand how much the CAT aggregation, or let's say the overall losses might just look like. So those data points are very, very relevant from a PNC perspective. And again, all these subjective judgments or calls that I was talking about from a business angle as to how the rates would move, your reinsurance team might just help you assess what the market typically is looking like, globally what's happening, how do you expect experience adjustments to come through as part of your future reinsurance rates. All these inputs are very, very valuable from a PNC perspective, more particularly for property line, wherein the reinsurance typically tends to be quite excessive.
I would would like to continue with you, ma'am. And can you just tell us how will you find a balance between business volume and business profitability while optimizing reinsurance? And this you could answer in context with, the evolution of a company, whether it's a startup or it's in the middle stages of evolution or it's a big company. How will you then optimize the reinsurance program considering the business volume that's written?
Do I answer? Because he's... Okay. I'll try to summarize it very quickly. So, like you said, and I think I briefly covered it in my slides as well, what stage are you in within your business is very, very key because your reinsurance needs might be very different. So for a startup, typically, you'll see that they don't have a lot of volume for them to be able to cover the variability that might arise out of business, which is why what we've typically seen is companies tend to go ahead with a lot of quota share arrangements. However, when they're moving and building more and more volumes, they start playing around with these alternate structures. Again, even medium-sized companies, they tend to be more cautious. So you'll see a mix of, let's say, if I were to just specifically quote property, you'll see a mix of quota share, surplus, and some XOL contracts coming into play. Then, of course, larger players, you have a bigger book of business and a bigger balance sheet to support such fluctuations. So you typically see that they are the ones who try and literally derive the best out of these reinsurance optimization strategies, and they are the ones who typically try and evaluate different strategies in terms of, let's say, reducing surplus, reducing facultative covers, and basically trying and retaining more and more risk on their book of business. So what we've seen in our experiences, these are the companies who try to move away from proportional contracts and move more towards non-proportional contracts. However, having said that, obviously, what cost these non-proportional contracts are coming in at becomes a key.
Yeah, so looking at the climate change that's happening and increasing risk of cat exposure and a huge volatility as a cause of that, how would you then, peg your confidence level on RMS models or any such other models, and what would you do to, to build that buffer in your pricing solutions?
Well, I would, first of all, admit that I am probably not the best person to answer this. However, what I've seen typically in my experience, I'd just like to cover that. Typically, what I've observed more so in the global markets when people have started realizing the impacts of climate change, there what we've usually seen is sticking with just one traditional vendor for CAT results is not what people are doing. So they tend to evaluate multiple models. You have RMS, you have JBA, then there are a few others as well. For catastrophe, they go, for earthquakes, they go ahead with EcoCat. So there are basically multiple vendor outputs that they try and evaluate. They don't do it year on year, of course, but let's say once in 2 years, they evaluate against these and try to assess what sort of results are coming, and then how much confidence are these vendor providers giving you in terms of their results, and then basically feed into their gross pricing as well as reinsurance purchases simultaneously. So mostly subjective overlays, I would say, but yeah, of course, they try to account for it.
Thank you so much. I think all the presentations were very, very informative, very interesting. Thank you so much.
Yeah, that's
Thanks
true.
a lot.
Okay. Now, I would like to request Ms. Girija to present the token of appreciation to our honorable speakers. Now I would like to request Mr. Ashish Ranjan, Honorary Secretary III, to present the token of appreciation to Ms.Girija. Thank you, everyone, and it's time for the tea break. Actually, we have already passed the tea break time, but let's circle back in 15 minutes for some more interesting topics. Thank you. Thank you. And peers who are